Hello, everyone. Welcome to another exciting session of the Lawyers and Energy Network Training Series in partnership with Centurion Law Group and Broomshi Consultancy. Today is the 7th day of the training, and my name is Rakiba Oloko, the Executive Secretary of Lawyers and Energy Network, and I'll be moderating today's session as always. Yesterday, we had with us Mr. Emeka Osuji, a director in the law firm of Olaniwun Ajayi LP, enlightening us on part 1 of the practical steps to drafting agreements in the African energy industry, with particular focus on the gas transportation agreements. Moving forward today, we will be having with us to discuss part 2 of the practical steps to agreement drafting in the African energy industry, focusing on asset sale and purchase agreements, farm-out agreements, and joint operating agreements. Mr. Oladotun Alokolaro. Mr. Oladotun Alokolaro is a seasoned legal practitioner with years of critical experience in corporate and commercial legal practice and core expertise in handling legal issues relating to power, aviation, shipping, energy, and infrastructure. He is well versed in electricity, finance, oil, gas, and social and solid mineral law, and has advised several independent power producers, exploration and production companies, oil service contractors, multinationals, and high net worth clients on a wide range of assignments. He also provides advice and assistance on the legal and policy issues on electricity, mining, and oil and gas, legal and legislative drafting of statutory instruments, together with all aspects of law relating to the energy and infrastructure sector. He studied at the University of Buckingham, England, United Kingdom, and holds a master's degree in natural resources law and policy from the Center of Energy, Petroleum, Mineral Law and Policy, University of Dundee, Scotland, United Kingdom. Mr. Alokolaro has several continuing education courses, such as a law firm partner as leader at the Cambridge George Business School, University of Cambridge, and regulation of gas markets from the Florence School of Regulation, Robert Schuman Center for Advanced Studies, European University Institute. He is currently the senior partner and head of the energy and infrastructure team of Advocate Law Practice. He is the chairman of the Mining Committee, Nigerian Bar Association, section on business law, and a member of the International Bar Association, the Association of International Petroleum Negotiators, and the Nigerian Gas Association. Ladies and gentlemen, I present to you Mr. Ola Alokolaro. Welcome to today's session, sir. We are honored to have you with us.
Thank you very much, Rakiba, for the kind introduction, and good morning to you all participants. I shall share my screen with respect to our discussion this morning. And we'll be looking at some practical steps in terms of agreement drafting in the upstream oil and gas sector. Whilst this is an Africa-wide event, I shall try to limit the examples that I use to my experience in the Nigerian oil and gas industry. So we won't dwell too much about what is contained in the next slide, save for me to mention that I'm a partner with a commercial law firm in Nigeria, with offices in Lagos and in Abuja. And to the right-hand side of the slide, you'll see our core practice groups, which includes energy and infrastructure. So what will we be discussing today? We'll be looking at, how to go about drafting an asset sale and purchase agreement, and also farm out agreements, and lastly, how we go about drafting joint operating agreements and what to look for in drafting each and one of these agreements. We shall conclude with a group exercise just to see how much of what we discuss we can actually apply as lawyers to given scenarios. So hopefully the next 1.5 hours or thereabouts should be worthwhile in terms of knowledge acquisition. So an asset sale and purchase agreement, what is it all about, right? Typically, it's a form of acquisition of interests in the upstream oil and gas industry. So you have two forms. It can either come in the form of an asset sale, where you sell all or some of the assets of the company, right? So typically this may include the participating interests under a license, such as, let's say, a marginal field or a production sharing contract or a joint venture, and any properties attached thereto. The other way is to sell the entire shares of a company that has those specific assets. But note that you will be buying both the assets and the liability. So just to give you an example, the current proposed Exxon and Seplat sale is being proposed in a manner whereby the buyer acquires the shares of the companies that hold the interest on behalf of ExxonMobil, okay? And the same mode is being adopted for the Shell divestments. Now, this wasn't necessarily the case with the divestments that took place in 2014. Okay, those were more in the form of asset sales. So the two common ways to acquire participating interest is, either a straightforward purchase or what we'll be discussing later on, which is a farming arrangement. It's important to note that both the asset sale and the share acquisition may be subject to conditions, right? And typically, particularly where the JVs are concerned, and some of you who are Nigerians would have heard of recent with the transactions that I mentioned about the Nigerian NNPC seeking to invoke its right of preemption under the joint operating agreement that it has with the IOCs for the purposes of acquiring the interests that these IOCs are seeking to divest. Where you have an incorporated joint venture, right, there is also rights of preemption in those agreements, where you would need to, first of all, offer the shares that you're looking to sell to the existing shareholders, right? So in essence, you would need to get their consent. Another condition is, and it matters not whether it is a share sale or an asset sale, is the fact that you must procure ministerial consent, Okay, so let's look at what steps you should generally take when you're looking to complete an asset sale transaction. Okay, so whether you're selling by yourself, when I say by yourself, your company, or you're doing it through an advisor, the key is to identify the assets which you wish to market and sell. Once you've done that, seek to enter into a confidentiality agreement with a potential buyer before granting them access to the data room or issuing them bid documents if you're doing it through an advisor. Then you issue the bid package, right, which would include the offering presentation and any draft transaction documents such as the sale and purchase agreement, and then you grant the access. Remember to ensure that the bid documents are non-binding. Parties thereafter, typically enter into a letter of intent or a term sheet or an MOU, right, which tend to include or should include the purchase price and the description of the assets which are for sale. It is important, if you're representing the purchaser, to ensure that you conduct extensive due diligence prior to the execution of the sale and purchase agreement. What this does is allows you to have, one, an understanding of the assets, two, the associated risks and consents and approvals that may be required. Thereafter, you enter into the SPA, and the key provisions in your SPA would include the asset description, representations and warranties to ensure that the seller has the requisite title, it's free from any abandonment or decommissioning issues, and any liabilities, existing liabilities are taken care of, and also you're provided with the right indemnities, right? And then at the closing, like I said, as required under Nigerian law, you would require ministerial consent, and then there may be other condition precedents that you've attached or made conditional to purchasing the asset, which must be satisfied before closing. Otherwise, if those CPs are not satisfied or waived, then you will be looking at terminating the SPA in itself, and there would be no deal. Okay, so let's take a look at the key clauses in an asset sale and purchase agreement. So you have the description of the interest or the asset which you're looking to dispose and for the purchase to purchase. You have what the consideration should be, and that's in terms of what the money is or what the cost of the asset is. You have the conditions precedent that I spoke about, and then you have the completion or closing provision, whether there are any specific things that either the seller or the buyer needs to do for closing and completion to occur. You have the representations and warranties, which must be given by both the buyer and the seller. You have ongoing obligations and liabilities. What are they? And then, how are you, the purchaser, indemnified against such ongoing obligations and any liabilities? You have the requisite notices, provisions, any cost and expenses, whether one party is going to bear them or each party is going to bear it individually. Then you have taxation. Are there any capital gains tax requirements, or in terms of the purchaser, what taxes would they be responsible for? How do you apportion who pays what tax? Then you have the confidentiality provisions. Obviously, you want the deal to remain confidential, right, until it's sealed, right? And then any variation as to terms would need to be agreed by the parties. Can a party assign its obligations under the asset sale and purchase agreement, whether to an affiliate or otherwise? And then, of course, the restriction of rights of third parties to the contract. So I've highlighted some of the key provisions for us to look at in a bit more detail. So, description of assets. It's important that parties clearly define both the assets and related interests that you're looking to sell as a seller and purchase as a buyer. In terms of conditions precedent, right, it may be that the sale is conditional upon procuring a number of approvals, like we spoke about earlier, ministerial consent, a waiver or non-exercise of the rights of co-venturers, or of any rights of preemption under the JOA. We spoke about that slightly earlier as well. And then there may be need to procure approvals from each of the other co-venturers in accordance with the terms of the JOA. Okay? And in terms of completion and closing, clearly that would occur once all conditions precedent have either been fulfilled or waived by the parties. So with, let's say it's with a share sale, upon completion of filings and procurement of authorizations from the Federal Competition's regulatory body and the Corporate Affairs Commission. Okay, in terms of representations and warranties, right? Typically, both parties will make the representations and warranties, but you would want the seller's reps and warranties to be a little bit more fulsome and more robust. So their representations would include as to title and their right to sell, that they have the right to sell, and they own the assets that they wish to sell. The seller would always look to limit its environmental representations, right? And would always want to pass that on, that risk on to the buyer. I think you will probably find, I haven't read all the cases, all the facts of the case, but I think that there was a recent sale in 2014 whereby such environmental representations were limited by the seller, and the purchaser is now taking the seller to court for not providing the right representations and warranties, for breach of reps and warranties, basically. Also, the seller would also want to limit his warranty as to the accuracy of technical and commercial information, and will most certainly not give an undertaking as to how much production there is or what the likely flow rates from those assets will be. In terms of ongoing obligations and liabilities, dividing liabilities between the parties after closing is usually a point to negotiate, right? If the seller is exiting completely the asset, it usually wants the buyer, like I said, to assume all or nearly all of the liabilities, right? But you, as a buyer's counsel, what you should look to do is to hold the seller to remain responsible for liabilities arising while it was the owner of the assets, right? With the buyer responsible for any liabilities that may arise thereafter. There are other liabilities that the purchaser should concern itself with, and that includes the commissioning issues and environmental liabilities. So that is the asset sale and purchase agreement in a short introduction. We should now move to farm-out agreements. What is a farm-out agreement? It really is another means of divesting an interest in an upstream asset. And it's assigning of a part of an interest in an asset to a third party in return for an obligation, i.e., for the development of the asset. So if, for example, you've purchased an asset as company A, and you've hit bad times financially, or your head office has decided to focus more on its Asia operations, for instance, right? That means your Nigerian asset is not going to be developed as quickly as it ought to, because funds are being channeled to much more profitable ventures. But you still want the asset to be developed. What do? You perhaps look for a company that is seeking to acquire an interest in the asset which has the requisite financial wherewithal to develop the asset. For the person acquiring the asset, right, it may be that they are looking to expand their own portfolio and diversify it and see an opportunity, right, with this undeveloped asset. If you also look at the marginal field program pre the introduction of the Petroleum Industry Act, these also operated under farm-out arrangements. And those farm-out arrangements are slightly different from the traditional farm-out arrangements that I just explained. And they differ in the sense that, yes, the IOCs own the asset. They didn't find those assets worthy of production in their portfolio. So for the purposes of empowering indigenous companies, the federal government introduced the marginal field regime and basically mandated IOCs to farm out those fields to indigenous companies. So fields which have been left unattended for 10 years or more were now classified as marginal fields. And then the IOCs were mandated to farm them out to indigenous companies, right? And in return, the IOCs would get an overriding royalty. And of course, what the intent was was to boost Nigeria's production. Whether we've achieved that or not is a completely different story. So let us continue and look at what the key considerations for a farm out should include. So obviously the farmer must have ownership of the license in terms of interest in the license, right? It must have insufficient budget for its operations. The farmee finds the asset attractive and wishes to increase its own asset portfolio. The farmer transfers some of its own interest in the asset to the farmee, right? With the undertaking from the farmee that, let's say, it's a function of drilling additional wells, 2 or 3 additional wells, as provided for in the work program that the farmer has submitted to the federal government, right? So the farmee with the money would undertake, right, to fund the drilling of those additional wells, right? And then in return, it will be granted interest in the asset. You must know that if you fund the wells in accordance with those with the work program and it's dry hole, it's a risk that the farming has taken, right? So that takes us to the next issue, which is the risk and the cost of undertaking those activities needed to bring the asset to production is assigned to the farmee. And of course, nothing goes without the consent of the regulatory authority. So what are the key clauses? The grant of farm out interest by the farmer to the farmee. What are the issues associated with the transfer and completion in terms of any CPs? What will the consideration or the farming fee be, if any? Representations and warranty, again, reps as to title and other environmental issues as well. What is the definition of the farm out area? And if there's a limit to the depth to which drilling can occur, that is typical in most farm out agreements with indigenous companies, between IOCs and indigenous companies in Nigeria. And if the marginal field holder drills beyond the agreed depth, well, first he must inform the IOC that it wishes to drill further. The IOC must consent, and so must the regulatory authority, right? And of course, there may be additional negotiation around royalty rates. Okay, so what is the financial obligations of the farmee? What must it commit to the operations, right? What are the operations going to be? Obligations of each of the parties. How do we apportion taxation? Typically, each will be responsible for its own portion of tax of any production. Health and safety, environmental standards, of course, talking about existing farm-out agreements with marginal fields. This is a major consideration for IOCs. You know, their global image is of major concern to them. So they typically place very stringent health and safety environmental standards on the marginal field holders, the farmees, right? How is the evacuation of the petroleum be done, right? If you look at the marginal fields, they tend not to have the financial wherewithal to embark on evacuation, evacuation infrastructure. So they tend to rely on the existing IOC evacuation infrastructure, which typically comes at additional cost, right? It may be that you will enter into other agreements, such as crude handling agreement and crude transportation agreement, which would be outside of the scope of the farm out agreement. Then, of course, there's the issue of abandonment security, right, which the statute, the PIA now provides for, but hitherto was a clause that was negotiated not in existing farm-out agreements with marginal field holders. Of course, there's the issue of force majeure, key to understand and define what would amount to force majeure. Typically, they wouldn't want that affecting any royalty payments. What happens in the event of default? Typically, the IOC would want provisions around their ability to terminate, particularly if it's a breach around issues of environment, and such breach is not remedied. Of course, insurance is also very, very big to them, given the fact that some of these marginal field holders are inexperienced operators. So the IOCs would want a very, very good insurance policy in place. Termination, of course, should there be breaches which are not remediable. Confidentiality of the terms of the farm-out arrangement, and of course, limitation of liability. Typically, with the farm-out agreement with the marginal field, they're usually based on as is, where, and where is contracts, which basically means the IOCs limit their liability to the full extent possible. So they basically pass on a lot of the risks to the marginal field holder, and it's important that the farmee conduct extensive due diligence on its own, because typically the farmer would limit its liability as much as possible. So let's go to the key clauses. Okay, so a farm-out agreement must establish the interests to be farmed out upon satisfaction by the farmee of the minimum requirements, right? The farmer is to determine the maximum interest which it is willing to commit to the farm out, and the maximum depth to which the farmee can drill, or any other monetary obligation that it's to commit to the operations. So what typically are the obligations of the parties? Drilling of a number of wells, or expenditure of a defined amount on the work program that has been agreed with the grantor of the license. Assignment of the farm out area by the farmer, payment of overriding royalties by the farmee upon production, and procurement of ministerial consent allowing for the assignment or the farming. And of course, abandonment security in terms of provision of abandonment security for wells drilled. So that's a farming agreement in a snapshot, right? Underpinning majority of the operations in the upstream oil and gas space is the joint operating agreement, which basically governs the relationship of co-venturers. So we'll discuss that. It's a lot more lengthier than the others. And let's start. So for you to understand the joint operating agreement, it's important to understand the concept of joint ventures in the oil and gas industry and why joint ventures are utilized, right? So why a joint venture, right? Typically, upstream oil and gas operations are very expensive and risky ventures. If you know a little bit about it, you could spend $200 million and come up with a dry hole and you have nothing. So you spend $200 million and you get nothing, okay? So what typically happens is, why should I only spend $200 million? Why don't I ask Mr. B whether he would be willing to join me on the venture and we split it half-half, okay? Right? So the intent of joint ventures is to reduce costs and, of course, reduce associated risks, okay? It also allows for the sharing of know-how and technology. So whereas, you know, my technology is dated, you know, when we talk about dated furniture, you know, maybe somebody has, you know, furniture of 1980s in their house, but somebody is more contemporary and has more up-to-date furniture in their house, right? So in terms of equipment, Mr. B equipment is up to date, okay? Sorry, I'm not quite sure what this is. Okay, so we now decide, okay, Mr. B, why don't you bring your technology, or I bring the money, or we both bring both our technologies and collaborate and see, you know, how we reduce the cost and the risk and ensure that we actually produce. Okay, so what are the types of JVs commonly used, right, in upstream oil and gas operations? You have the incorporated joint venture, right, which is not common, right, though the marginal field bid round of 2021, right, it has introduced that concept. So each marginal field awardee, whilst each marginal field awardee was awarded an interest in a field, you probably had 3 or 4 of them, and it was, you know, if 100% participating interest in those fields was split, let's say 25% each, okay? And the directive from the then DPR is that all of you must come together and form one company, right? Which is an incorporated joint venture, right? And it is that one company that is to be the operator of the marginal field, right? Then you had, so that's incorporated joint venture. Then you have unincorporated joint venture, which is what we're more commonly used to, which is where you have NNPC owning a certain percentage, Shell owning a certain percentage, AGIP, ENI, and Total, owning a certain percentage, right? So each of those companies are individual companies, right? But they're working together on developing a particular asset. So what do JVs do, right? What do joint ventures do? They allow each venture partner or allow the venture partners to set clear parameters to govern their relationship as project participants, right? And it also establishes rules for them to be able to conduct operations under the underlying license, whether it's a PSC, right, or a concession, right? So the unincorporated joint venture also applies to PSC as well as concessions. So what's the fundamental difference between IJVs? I think I've explained that, and it's IJV involves the creation of a separate legal entity, so everybody becomes shareholders under that entity, whilst with the UJV, each joint venture participants acts as a separate legal entity under an umbrella joint operating agreement. So I have here a diagram explaining both the UJV and the IJV and how the joint operating agreement comes about. So if you look, excuse me, if you look at the UJV, so you have the granting instrument, which is a PSC or a concession. You have the MACM, right, which is where you find NAPIMs, right? And then each member of, so NAPIMs will represent the government, just to ensure that the costs of operations are well managed and it's not, free for all, right? But the management committee will consist of members of each of these participants, okay? Right, each of these participants has been granted 50% participating interest, company B 30% participating interest, company C 20% participating interest, okay? So when we were, just to take you back a little bit, when we were talking about each of the means of divestment, right? So company A, right, could farm out, let's say 10% or 20% of his interest here, right? But it must be subject to the consent of B and C, right? And also the consent of the federal government up there, okay? Or so it could sell that directly, or it could have somebody farm in, right? Again, all of that will be subject to the consent of its co-venturers and the government up here, right? So back to what I was saying in terms of management committee to approve costs for the work obligations, right? Now, what governs the relationship of company A, B, and C is the joint operating agreement, okay, which is the JOA here, right? And under the JOA, there's an operating committee. That operating committee now does not include NAPIMs, but includes representatives of A, B, and C, right? Okay, from either one of them, right? One is designated the operator, okay? So the operating committee determines the work program, the authority for expenditure of each item under the work program, right? And then the operator carries out the operations, which is the joint operation, on behalf of company A, B, and C, okay? Now, let's go to the incorporated joint venture structure, right? We're talking, bear in mind that we're talking about JOA, And I'm just trying to show you how the JOA is applicable. Okay, so let's look at the IJV structure. So talking about the marginal field, which is the example that I use, you will have a granting instrument, which is the PPL, as provided under the new PIA, right? That PPL will grant 100% participating interest to the joint operating company, which is the one that you have to incorporate at CAC. Now, the government had awarded company A 50% participating interest, and awarded company B 50% participating interest in let's say Ibok field, right? Okay, now they have to now transfer this into shareholdings, right? It is represented as shareholding in this joint operating company that the government is going to issue the license to, okay? Right? So what do you have? Rather than have the JOA governing the relationship of the parties, right? Since they are both now under one company, one umbrella, what you will have is a shareholders operating agreement, right? Now, what is that? That is an amalgamation of a shareholders agreement, right? And some of the provisions that you'll find in a joint operating agreement, right? And of course, right, under that, flowing from that agreement, you will have a management/operating committee that maybe the shareholders would have nominated, you understand, that would work on the work program submitted to the government, right, and ensure operations is carried out on behalf of everybody, right? And at the end of the day, rather than unlike here, whereby each party can lift his own petroleum when crude oil is found, right? With this arrangement, what you would have is the company, right, would dispose of the petroleum, right, and pay dividends to company A, awardee A, and awardee B as shareholders in the JOC. Okay, maybe I should stop there for now before I go to the key differences between the two, right? Or should we take the key differences and then we'll just discuss this?
I think we should just take the key differences, although someone wants you to enlighten us on the meaning of farm out, that is, who is a farmee, farmer, and farmer.
Okay, okay, so the holder of the interest is the farmer. The person bringing the money and who is to carry out certain obligations. So that obligation could either be bringing of money or could either be drilling of wells if they have the technical competence, okay, right? So that's the farmee. I hope that explains that.
I'm sure it does. Juliet, are you comfortable with that explanation? Can you unmute yourself, please? Madam Julie? Galaxy 550. I'm sure she would have understood because she's not responding here.
Okay, so we'll just move on very quickly to the key differences, some of which I've explained already, but let's go through it, okay? So what's the key differences between the two? In terms of formation and contractual framework, okay? With the UJV, each party enters on its own behalf into the joint operating agreement, right? And like I said, that joint operating agreement provides a framework for the management and operation of the asset. and it sets out the rights and obligation of each party in relation to its other co-venturers, okay? Now, with the IJV, it's a completely, like I said, separate legal entity, right? Which is incorporated subject to the requirements of CAMA, okay? It's formed pursuant to an Articles of Association, and the relationship is governed by a shareholders agreement. And like I said, the 2021 marginal field guideline required awardees to form this IJV for the purposes of operating the marginal field, right? Let's talk about management and control, okay? So from the diagram I said to you, one of the three parties, right, who are co-venturers would be appointed as operator, right? Who will be responsible for the day-to-day technical operation and management of the asset on behalf of the three, okay? Its scope of duties and its discretionary powers are set out in the joint operating agreement. And some of these duties we will look at shortly, right? The ultimate decision-making, like I said to you, is reserved for the MACOM, which includes NAPIMs, particularly when it relates to PSCs, okay? And then, you know, the operating committee consisting of each representative of the parties, right, are the ones that come up with the work program, the budget, you understand, that will be, or approve the work program and the budget that the operator prepares. In terms of the IJV, right, it's managed by a board of directors, right, who are appointed by shareholders, right, in accordance with and subject to duties and obligations set out under any applicable law. So provisions around board representation, rotation of senior roles, and decision-making are usually amongst the most negotiated shareholders operating agreement provisions. In terms of liability, right, with a UJV, the liability of each joint venture partner is limited by reference to its overall percentage interest as allocated under the license. While the liability of the partners in relation to one another and certain third parties may be limited in the JOA, the liability of the joint venture partners under the license issued by government is usually joint and several. It's important that you make that distinction, okay? Right? In terms of the IJV, the liability of each shareholder in the IJV is limited to its contribution and assets to the joint venture, okay? And then in terms of termination of either the JOA or the parties will need to can agree to terminate the JOA subject to any residual liabilities that there may be. And termination of the IJV is more complicated as it will require you to dissolve the company, which is subject to CAMA, okay? Now, in terms of assets, profit sharing, and costs, what are the key differences, right? In a UJV, each party effectively holds an interest in the joint operational assets proportionate to its participating interest under the license. So based on the picture that we saw earlier on, you know, I think it's 30, 30, 40. So that's basically how the interests in the joint operating assets will be held. A party may seek to use its share in the joint asset as security for its own funding commitments. However, the ability to do so may be restricted under the terms of the JOA. Okay. Joint operations under a UJV structure are funded via cash calls, right? And I think some of you would relate to that in terms of NNPC cash calls, which recently we cleared a significant backlog of NNPC's cash calls for its joint venture assets. Okay. Each party owns its share of production and is entitled to take, market, and sell such share as it wishes. In practice, the operator often markets and sells the petroleum on behalf of all of the parties and distributes each party's profit share subject to a set of separate off-taking and marketing agreements, right? In terms of IJVs, equity or debt financing can be sought by the IJV in its own right as a legal entity. Now, the recent Petroleum Industry Act now allows what was previously a UJV, right, with NNPC, Shell, Ajib, and Total, to form an IJV for the purposes of being able to leverage on the assets and source both equity and debt financing, okay? So typically the working capital and operating costs of the IJV will be funded by its shareholders, right? But that doesn't mean it cannot seek to get a loan, right? The assets are owned by the IJV, right? And can be used as security by the IJV, right? Profits are paid to the shareholders through dividend payments on the basis of a dividend policy agreed and set out in the shareholders' operating agreement. So I'm going to stop there just for a moment for us to ask any questions that they may need to ask before we now go in depth into the joint operating agreement principles.
Okay, thank you so much, sir. I guess the lady that asked that previous question was not around. She had network issues, but she just joined. So Galaxy A50, your question has been answered when you were not around. I'm sure when you go back and rewatch the recording, you would see, you get your answer, because I don't want to draw a speaker back. We also have someone here, Peace Adeleye. Peace Adeleye, do you want to ask your question in person by unmuting yourself, or I should read it for you? Okay, go ahead and ask your question.
Thank you so much. Good morning, sir, and thank you so much for the presentation. I recall that when we were talking about the transfer, the acquisition of sale of assets, you say it's subject to minister's consent and to the rights of preemption. So please, can you help me explain the rights of preemption? I don't think I understand the concept. Thank you, sir.
Okay. So we will actually be talking about it a little bit more under the joint operating agreement, right? But you know, since you asked, I'll give a little insight into it. So as co-venturers, right? So we've entered into this venture together, the three of us, right? And you want to sell yours, okay? Right? It's only right that we as your partners should get the first right of refusal, right, on your shares or your interest, right, before you offer it to a third party, okay, right? We started together, we understand each other, right? Rather than allow a third party to come in, give us a chance to match whatever offer, right, that you're offering to a third party, right? Obviously, right, if the offer being made by the third party is outrageous, okay? Because we know the asset, we understand the asset, right? So if you're selling, or if you got an offer of 500 million, right, for what ought to be 300 million, right, we are not going to exercise our right of preemption because we know that it's 300 million. Okay? Do you understand? So you have to really ask us permission first before you, or give us a right to match the offer before you sell it.
Okay, thank you, sir. So does the Minister of Petroleum, does he have a right of preemption in JVs?
No, the minister doesn't have a right of preemption, right? The co-venturers are the ones with the right of preemption. The minister is not a party to the agreement, right?
Okay.
But what the minister does, right, is whatever transfer or sale is going to happen, he must consent to it, okay? As the overseer of the sector, right? Coupled with the fact that we don't want, you know, people who don't have the necessary technical capability or financial capability in the sector. The sector is the sector that feeds Nigeria. Okay, so we don't want unserious players. So those are the reasons. Neither do we want a monopoly. You understand? So if you look at the reasoning that was given by the NUPRC lately with respect to the Exxon and Seplat transaction, right? They said, the minister rejected consent based on the fact that it wasn't in the public interest. Okay, so, I mean, I have my views about that as to, how that looks to the international community, but it could be said that that's what the federal government was trying to prevent in terms of creating some form of monopoly at the end of the day.
Okay, thank you so much, sir.
Yeah.
So I don't know if another person has a question to ask you, or before we continue, I just want to know if these principles, the key clauses and provisions you mentioned in the JOVs, JOA, asset sale, and JVs, if they are also applicable to the, other countries in Africa, Oh,
no. So you're quite right. I mean, there are standard model documents, SPAs and farm out agreements abound. I mean, if you're a member of AIPN, you understand you have access to standard JOAs and farm out agreements that you can use, and also SPAs, right? The differences will be, you ensuring, right, that the provisions are drafted to best protect and align with your own client's interest, and also align with applicable law. Obviously, there are different nuances for civil codes and common law codes, right? So it's inherent in lawyers from each jurisdiction to know what to do.
Okay, Mr. Olawale Adebiyi, do you want to unmute yourself to ask your question? Olawale Adebiyi, please.
Ma, you can read the question the way I sent.
Okay, so
it's fine that way.
Question here is that he wants to know the parameters set by the Petroleum Industry Act for foreign participation in GOA in Nigeria. He now said, although there has been a huge avalanche of divestment in assets by the known IOCs, so basically his question borders on foreign participation in oil assets by African oil companies. He's seeking clarity on that.
Okay, I think the key there is our local content laws and what our local content law says, you understand, with respect to who can participate in the oil and gas industry in Nigeria, right? And, you know, the local content law is absolutely clear on that it has to be a Nigerian company, right? And it sets the threshold for foreign participation. So, you know, that's clear.
So I don't think we have any question right at the moment, sir. So maybe we can proceed to the other presentation, sir.
Okay, so let's dive straight into the joint operating agreement, you understand? And what are the key principles, underlying principles of a JOA, right? Firstly, it's not a partnership, okay? It must be drafted to avoid being deemed a partnership, though it performs a similar function to a partnership agreement, often to take advantage of more favorable tax treatment, okay? Secondly, the liability of the operator. So if three of you are choosing me from the three to be your operator, we're all in this together, and I should neither receive a gain nor suffer a loss from acting on our behalf, okay? Thirdly, right, the liability of the parties under the JOA in relation to one another is several and not joint, but it will be joint, like I said, as to the grantor of the license, okay? So let's look at the common provisions of a JOA, okay? So first is, what is the scope? Or what would the scope of a JOA be? Obviously, it would be in relation to a specific asset, right? And then what will be the term of the JOA, typically for the life of the operation of the asset, right? How do we appoint to remove an operator, or what if an operator wishes to resign? How would that work? We'll need to create provision as to how all of this is achieved. What will be the scope of the operator's duties, and whether he can limit his liabilities or not, right? How do we treat the operator's personnel and secondees? Remember that he's acting on our behalf. So he will be using his own staff, right? And probably the rest of us can second our own staff, right, to work with him on the operation, so that members of our own staff also learn at the end of the day. We should not just be, you know, watching partners, although in some circumstances, some companies prefer that limited role. How will the operating committee be constituted? What will their role and responsibilities be? What is our work program? And what budget are we attaching to the work program, right? How do we deal with operation by fewer than all parties in the JV? So let's say there are three of us, right? Two of us want to do something, one of us doesn't, or two don't want it, one person wants it. How do we deal with that issue? How do we deal with the issue of default? Remember, everybody is supposed to bring money, and everybody is supposed to have certain obligations. If they don't fulfill those obligations, how do we deal with it? How do we dispose of the production? Is each person going to be allowed to lift or is the operator going to lift on our behalf and then share the money to us, right? How do we deal with the issue of decommissioning and abandonment? The PIA now provides very, very clear and stringent provisions as to how decommissioning and abandonment is to be handled, right? How do we deal with surrender, surrendering part of our field, right? Or how do we deal with extension and renewals of permits? Who is to do that on our behalf, right? What about transfer of interest? I want to transfer my interest. What am I supposed to do, right? Again, you know, rights of preemption, or notifying my co-venturers and allowing them an opportunity to match the offer, right? I don't want to do again. How do I withdraw? Am I allowed to withdraw, if at all, right? How do we handle the issue of tax and our tax obligations to the federal government? Okay, remember that that obligation, right, will likely be joint. You all have to pay your taxes to the federal government, though you may be able to do it individually based on what you earn, or the operator do it on your behalf, right? All our operations are to be treated with strict confidentiality in terms of you know, our data and things of that nature that we've you know, been able to procure from our operating the field. The intellectual property of any equipment used, who does it belong to? How do we apportion it, right? Force majeure, right? What event will cover force majeure, right? And what event will not? What will be the applicable law? It may not necessarily be, HOA need not necessarily be, let's say if the operations are in Nigeria, to be governed by Nigerian law. You could have a choice of law clause there and choose another jurisdiction, right? Dispute resolution. How is the dispute resolution to be handled? Is it by arbitration, or would litigation suffice, right? And then allocation of costs, accounting procedure, right? How do we, you know, deal with all the accounting? What procedure are we to use? What would be the lifting procedure for the purposes of this, disposing production, decommissioning procedure, and last but not least, anti-bribery compliance, which is a major issue. So let's look at, I've highlighted some of the key clauses for us to discuss, right? Let's look at the appointment, removal, and resignation of an operator. So we've agreed that one of us is to be appointed as the person with the largest participating interest would want to be the operator, okay? An operator can resign or be removed and replaced, right? So under what circumstances can you remove an operator, right? Obviously, if he becomes insolvent, you will have to look for somebody else, right? If he breaches his obligations and does not remedy it, right? You know, that's also a ground for you to remove the operator. Or if it conducts or commits willful misconduct, okay? And we'll discuss the issue of willful misconduct in a minute, right? The removal of the operator always usually requires the unanimous agreement of all the non-operating parties. So the operator has two distinct capacities. It has all the rights and obligations attaching to its participating interest. So he is also a party to the joint venture. So it has to meet his own share of the costs, right? And he's also entitled to vote like everybody else, and to take its own share of production like everybody else. In addition to this, right, he also has the rights and obligations accorded to him or her as the operator, okay? So what is the typical scope of the duties of the operator, and to what extent can the operator limit its liability. So based on the diagram I showed earlier on, I was clear in showing that the operator that is appointed conducts joint operations as agreed by the MACOM first and the operating committee, right, on behalf of the entire group, okay? So it acts as an agent responsible for representing the group in dealings with the government and maintaining the grant of the right. So it must maintain the license on behalf of all of the parties, right? It prepares and implements the work program and the budgets required for joint operations. It conducts all of the petroleum operations, right, on behalf of the parties. None of the other parties can interfere once you've designated one of the parties, the operator, save for voting and the other things that non-operators can do. It provides all the necessary technical and advisory services that is necessary for joint operations, right? And engages in the execution, entering into and supervision of all contracts with third parties for services and materials on behalf of all of the parties, right? But in doing all of this, it must keep the non-operators informed of all significant matters that concerns the joint operations. Last but not least, if the joint venture is taken to court, right, it is the operator that would defend it on behalf of the non-operators, okay? So with all of these responsibilities that you've given me as the operator, right, what if something goes wrong? Will I be liable as the operator? Because I need to know what my risks are in taking on the role. So as an operator, you will not be liable to non-operators for any error or mistake unless the same is from willful misconduct, right? Okay. And willful misconduct is usually defined as a deliberate or reckless disregard of the terms of the joint operating agreement or good international oil field practice, okay? So you ought to be liable for any errors or mistake arising from willful misconduct. But in practice, right, it's typical to exclude all liability for consequential loss, loss of production or loss of profit, even where it arises from willful misconduct. Okay, so if you're reviewing a JOA, right, if your client is the operator, it is very, very key that you look at what its obligations are, right, and seek to limit its liability to zero, if you can. Okay, so what are the roles and responsibilities of the operating committee? So the operating committee typically consists of one representative from each of the parties in the co-venture, right? The decision of the committee is usually weighted by voting, right? So each representative has one vote equal to their participating interest of the party they represent, right? So if there's a proposal at the operating committee, right, it will be carried if the representatives holding participating interest equal to or greater than a stated pass mark. Okay, so let me just go back up to that diagram for us to look at the participating interest here, right? So one has 50, one has 30, one has 20. 50, 30, 20. Okay, so typically the pass mark for passing a decision will probably in this instance be around 75%, right? And with that, you'll probably have company A and company B. If they both approve something, then the likelihood is it will pass. Okay, right? Only because 20% and 30% will not arrive at the required 75% needed for approval. Okay, so on average, what you will find is that pass marks are always above 50 anyways, right? It's often a contentious and hard-fought issue, right? But it's not something that is insurmountable, right? So typically all the main operational decisions are made by an ordinary pass mark vote, though JOAs can have a special pass mark vote for certain decisions, okay? So let's look at the typical things that would require an ordinary pass mark vote, right? So we want to obtain, buy, or swap seismic data, right? Drill a well, locate the depth and target of a particular well, plug and abandon a well, approve or amend annual programs and budgets for exploration and appraisal, development and production phases, approve an authority for expenditure, approval of the award of any major contract, determining the rate of production, right? Settling a major litigation, public announcement concerning joint operations, right? So there are a number of other decisions that may not necessarily be subject to a pass mark vote, but are decided in some other way, maybe by unanimity or otherwise, right? So if you want to amend the JOA in itself, right, you would need the unanimous agreement of the parties. So we want to surrender all or part of the contract area because, it's not just worth our while. Again, you will require the unanimous agreement of all of the parties. Amend or terminate agreement with the federal government. Again, you will require the unanimous agreement, right? Performance of compulsory work obligations, right? It could be by ordinary vote, but maybe tiebreak. There may be need for tiebreak provisions. Removal of operator, like we said, right? Unanimity. Obtaining insurance, right? Typically, it will be by ordinary vote, right? But each party may be able to make their own arrangement. It all depends, okay? Enter into a transportation agreement for the evacuation of the crude will probably require the unanimous agreement of the parties. If you want to approve a development plan, and we'll come to this issue in a minute when we talk about sole risk, it will be by ordinary vote with the right of non-consent if you don't want to participate. Abandoning joint operations, right? Unanimity, right? And approval for a party to assign its interest, which is what we had talked about with respect to farming and asset sale. You would require the unanimity of the other parties, but if they withhold consent, it must not be unreasonable. So let's just talk about sole risk, right? And this can be complex, right? but we'll try as much as possible in the next slide to break it down for all of us to understand it, okay? So, you know, a sole risk provision would apply where certain specific operations, you understand, exploration and development, are proposed, but rejected by the operating committee, okay, right? So the party that voted in favor of that proposal, which was rejected, has the right to conduct those operations at its own sole risk and expense, okay? So let's look at some of the other activities that may be conducted as sole risk operations, right? The acquisition of seismic data, okay? So if I propose that, look guys, we need to acquire another 1,200 kilometers of seismic data, and everybody says no, you understand, that's too expensive, right? If I have the money, I can, you know, have the operator conduct it on my behalf. The same for deepening or sidetracking of an exploration well in the course of drilling. The testing of a well, right? And the drilling of an appraisal well, okay? So how do these sole risk provisions work? Okay, so we know that the operating committee must reject a proposal, either to drill an exploration well or appraisal well. Then any party that voted in favor of that proposal may give notice to the others of the intention to drill that well at sole risk. Whilst it's saying it may give notice of its intention to drill that well at its sole risk, it doesn't mean that he's the one that is going to drill. He's just going to provide the money for the operator to carry out that drilling on his behalf, okay? So once he's given the notice that, look, I've made this proposal, the operating committee has rejected it, right? I want to drill this well on a sole risk basis. The other parties must let him know whether or not they want to join him in paying for the drilling of that particular well. If the parties that are wishing to drill now hold aggregate participating interest equal to or greater than the voting pass mark. So if A and B get the 75, that well is going to be drilled as joint operations, with 75 being the pass mark. But if B and C are the ones who hold the aggregate, you know, we have not reached 75, right? Okay, the operator has to drill the well on their behalf at their sole risk and expense, okay? Now, that's the drilling of the well, right? If that well now results in a discovery, so Mr. A that did not contribute, you understand, he can only now contribute, he can only now participate in the appraisal and development of that discovery if he pays B and C a penalty for not participating. So B and C took a risk. A did not want to take a risk. B and C now make a discovery, which they now want to go on and appraise and develop to be able to get production, right? A is not going to want to be left out, right? He may still not believe in the appraisal, you understand, right? And may not take part in the appraisal, right? But if they now get enough for him to develop, the likelihood is he'll want to participate. And for not taking the risk with the others, he is going to have to pay a penalty. Okay, right? So if that discovery gets to development, right, the penalty can typically be 10 times the amount that B and C spent, right, in getting to that stage, right? And the penalty can either be from what is produced, right, or he can do it in terms of cash payment. I think before we move on to the next clause, I want to stop there just to ensure that people understand what sole risk provisions are about. And if there are any questions.
An intervention or questions at this juncture before we move forward. You can raise your hand or send your interventions to the chat box. But do we all understand what it means by a sole risk operator?
Okay, can we move on, or
yes,
are there any questions?
I don't think we have any questions here at the moment.
Okay, so the next provision.
Okay, they are responding. They said it's very clear. The explanation is clear.
Okay, excellent, excellent. The next provision is the default provision, right?
Someone just sent a message. A message. It said, "What happens if a sole risk decision crystallizes into a default or damage to the asset?"
Okay, so how would a sole risk crystallize into a default when the party proposing the sole risk is the one funding it, right? It would only, I mean, the only default that could arise is, or it's not a default really, it's just a function of, you know, party A not participating. And what would then happen is, you know, that particular little field that you guys did sole risk on will be carved out separately, right? And, you know, the provisions such as how you share the cost on that would now be separate, and how you dispose the petroleum and how you share the petroleum from that particular field will be different, right? Remember that it is not the people proposing the sole risk who are the ones doing the drilling. It is still the operator doing the drilling who would, I mean, you would appoint an operator that is technically capable, you understand, right? To do to operate the asset on behalf of all of the parties. And if you recall earlier on, right, that we said if something happens by virtue of willful misconduct, right, typically the operator would still not be held liable.
So, sir, Mr. Adebi now went further to ask that if a sidetrack or request to drill deeper results into a loss of the entire well or hole, what should be done?
I think I just answered that in terms of limiting the liability of the operator, right? Typically, you would not, typically the operator would not be held liable, you know, for loss of production or anything of that nature.
So we can move on, sir.
Okay. So, in terms of default for failure to pay its share of cash calls and charges when due. How does default occur, or what circumstances could amount to default, right? So we talked about cash calls earlier on, right? That's how operations are funded. So your failure to pay your cash calls as and when due, right, would amount to default if not remedied, right? Your failure to maintain any security that may be required under the JOA or PSC, such as any decommissioning security abandonment requirement, you understand, could amount to a default, providing your own share, since you're in a joint venture, or perform its indemnity obligations under the JOA. So what would be the consequences for a default? Okay, right? Typically, it will be suspension of rights, right? Your rights to attend or vote at the operating committee meetings. You understand? Suspension of rights to take your entitlement to production until such time whereby your requisite share of cash flows that you missed has been repaid to the non-defaulting parties. Your consent could be withheld in terms of your ability to transfer your participating interest to other parties because you're still owing, right? You may not be able to transfer your PI except to a non-defaulting party who perhaps has elected to pay any outstandings to the rest of the non-defaulting parties. You may be denied access to certain information or not allowed to participate in operations voted on during the default period, right? So there are also other remedies that could be utilized for default, and that could include the forfeiture of your rights and title under the JOA, right? Or your participating interest being sold at a discounted price to non-defaulting parties. Okay, so disposition of production, we spoke about. Each party could be responsible for lifting and disposing of its own share of production, or the operator could be elected to do that on behalf of the parties and sell it on behalf of the parties, which would involve entering into separate offtake agreements, and then the proceeds from such sale shared amongst the participating interest holders. Okay. One key issue is the transfer of interest, which we had spoken about earlier. So the JOA will usually require that any assignment has the unanimous approval of the other parties, right? And it's important that the approval is not unreasonably withheld by any of the parties, right? Another sometimes contentious issue is this issue of preemption, which we spoke about. Under a classic preemption provision, a party that finds a willing purchaser for its interest is first obliged to offer it to existing co-venturers. And I gave this example earlier on, right? The co-venturers have the prior right to buy the interest on the same terms offered by the prospective purchaser. So that brings us to the end. I don't know whether we have time to share, Rakiba, the little group exercise that I have for the parties, for us just to have a quick discussion around that, so that there's some indication that people have taken away some items of the presentation.
Thank you so much, sir. But before we take that exercise you're talking about, Mr. Aloklara, I'll just like to, first of all, thank you for this beautiful and wonderful presentation. that you gave us today. It was so engaging and insightful, and we appreciate it a lot. You took time out of your very busy schedule, and I know personally that you are very, very, very busy. And for you coming yourself to give us this presentation, we are really grateful, sir. Thank you so much. Just to give a brief summary of what Mr. Luklara has been saying since morning, he started by introducing us to the forms of acquisition in the upstream oil and gas industry, which he mentioned as asset sale and the share sale. He then educated us on the necessary steps to be taken to complete an asset transaction, such as 1, identifying the assets to sell, 2, entering into a confidentiality agreement with potential buyer before data or documents are released, 3, issuing the bid package, 4, parties may enter into a letter of intent, 5, conducting the due diligence before entering an agreement, 6, entering into an SPA, and finally closing the transaction. He later showed us the key clauses to watch out for, such as the description of interest or assets, consideration, condition precedent, completion, representation, and warranties, etc. After a detailed analysis of the asset sale agreement, he went forward to analyze the farm out agreement, starting with the meaning of what a farm out agreement is, which he defined to mean an assignment of parent or an interest in an asset to a third party in return for an obligation, that is development of the asset. The key considerations were mentioned here, which include ownership of licensed interest by farmer, farmer's budget insufficient for operations, farmer finds assets attractive and wishes to increase its asset portfolio. 4, transfer of some of the farmer's interests. 5, undertaking by the farmer to undertake an activity. Risk and cost assignment to a farmer. And finally, the consent of a regulatory authority must be obtained. Key clauses to watch out for here is the grant of farmer, is the grant of farmhouse interest, transfer and completion, consideration, representation and warranties, financial obligations, operations, taxations, just to mention a few. Then he treated the joint operating agreement with us, where he made us to understand that for us to have a clear understanding of what a joint operating agreement is all about, we must understand the concept of the joint venture in the oil and gas industry. He then mentioned the types of JVs commonly used in energy transactions, which are the incorporated joint venture, that is the IJV, and the unincorporated joint venture, which is known as the UJV. He also enlightened us on what the JV does, the fundamental difference between the IJV and the UJV, the structure of the joint venture, and the key differences between the UJV and IJV. He then concluded by giving us the key clauses to note in a joint operating agreement and key provisions. So, sir, we can take the exercise now. The host will be sharing that exercise with us, and we can take it up from there, sir.
Do you have the exercise to share with us?
Yes, sir. One moment. We're trying to share it. Can you see the screen? Yes. Can we all see the exercise on the screen? The exercise is up, sir. So.
Thank you, Rakiba. Okay, can I just ask the participants to spend 5 minutes? So it's 12:43, right? So 5 minutes, 12:48, right? I want us to, based on all what we've discussed today, right, give answers or step-by-step guide as to how we deal with all the issues arising in 1 and also in 2. Okay. I think time is up. So do we want to share our comments in the chat box? Or in the alternative, we could have people in an orderly fashion unmute themselves and just take us through each one and what their views are.
So, sir, we have an Asian Prosper here who has given us the response, but I would like him to unmute himself so that he can walk us through his answer.
Thank you.
Mr. Asian, can you please unmute yourself? Okay.
Hello.
Hello, we can hear you.
Okay, I'm not an expert, but on the question one, what I thought, it is a situation where basically the company now wants to invest more of their money outside of Nigeria. So I thought that in that case, they may just be, they may farm out. They may farm out and get into a GOA. Just that's an option. And for the question two, maybe they just want to sell their assets. So I'm not an expert, but yeah. These are my takes.
Thank you, Anisette.
Okay, thank you, sir.
Anybody else? Anybody else?
We have Olawale here also giving his response. Can you please unmute yourself, Wale Adebi?
So, Olawale, I would like for you to address the numerous issues that are interwoven into one based on all what we've discussed today. There are a number of issues.
Hello. So I would say that the first one, since they want to divest, there should be a divestment, if I'm correct, in the first leg of the exercise. Crest Petroleum and New Bay Resources, they might arrange a farm out. Parties can come to farm into their interest for a stated period so that the PSC obligations under Nigerian law is complied with, and there are no, should I say, shortfalls. They wouldn't want to run foul of the law by not fulfilling the laid down obligation as regards to PSC that was signed by them. So they might invite parties to farm into the interest they already hold in the asset. That's the first leg, because they say they want to go to the Asian market or Asian oil assets because they are more prolific and the profit over there seem to be more attractive to them. So in order not to run far, okay, sir.
So I'm New Bay Resources, right?
Yes, sir.
And I say no, you can't. Can I?
The preemptive that takes us to that right of preemption when it comes to a farm out agreement. That first right of refusal ought to be given to the partner if they want to take over the portion of interest they have and add to their own. Fine. If they turn it down, there should be a cogent and convincing reason why they'll be doing that. The content should not be unreasonably withheld by them. There must be a cogent and convincing reason why they will be turning down that divestment effort or that intended farming arrangement or farm out if you want. So I think personally that a farm out would work so long as it's in compliance with the PSC in place, so long as it does not run foul of any law. For example, in our case, the PIA, all the well felt out obligations as regards to PSC. Now, if there's one in the new PIA, they comply with that and they do not run foul of the law. And since they want to go out of the country, they want to change other interests. At the same time, the company should not violate any laws laid down. Then on the second leg, sir, I would say that there's a transition period. There's a transition regime. Now the world is looking at renewable energy. The world is tending towards green energy, as they call it. So in order for them to reduce funding on the oil development of the assets in Nigeria, because they want to delve more into green energy now, I think I would say the 15 years transition regime, personally for me, I do not agree with that. I would say something more like, say, 30 years. The transition regime, we should plan, the plans and projections should be towards a 30-year tenure, a 30-year period. A 30-year period will fare well if they are looking at it. For me, personally, I stand to be corrected. A 15-year period cannot work. We still have fossil fuel in parts of Africa that are untapped. We still have parts of Africa that are just beginning to do appraisal wells. They are still planning, and they have their projections on development of those wells. And they are crude oil wells, the hydrocarbon, they need this purely crude oil, they want to still sell to the international market. So the transition regime, I do not think, personally, I stand to be corrected, the 15-year tenure may not work for now, but the plan can be initiated because the world, Europe is tending towards that as we speak. So Africa being an emerging market, if we're there yet, with the 15 years, they can start now, but I do not see it coming to fruition within the next 15 years. That will be my response, sir.
Thank you very much.
Thank you, sir.
I think we should try to have one more person share their views on both parts of the exercise before we call it a day.
I think Mr. Godson has written a lot here. Maybe he can unmute himself to be able to give his intervention.
Okay, good afternoon, sir. I wanted to add that with respect to the first issue, there's it's probably since only Crest Petroleum is seeking to focus on its Asian assets, and it appears that Newbay is still interested, they can also adopt a sole risk approach, a sole risk contract that will just allow Newbay explore the assets, and if maybe commercial discovery is made and Crest Petroleum decides to join at any point in time, they might have to pay the sole risk penalty. And also, if Crest wants to totally divest their interest, they don't want to be part of it at all, then they can also assign their interest to another party. Then, in addition to, for number two, just to add to that also, I think that since they just want to gradually reduce this and just want to take away the obligation to keep making expenses on the assets, they can as well just farm out to another party who can who may just incur all the whole expenses with respect to it and probably just be getting their overriding royalty interest. Oh, thank you.
Okay, thank you. Let me just correct one thing before I wrap up, right? A sole risk operation, right, doesn't, how do I want to put it? Just because one party says they want to undertake a sole risk venture does not mean, with respect to approved work programs, you understand, that has been approved by the operating committee, that the voting has gone beyond the threshold, that you will not pay. So the impression that Crest Petroleum doesn't have, that NUBE can conduct sole risk, right, may not necessarily arise unless it had proposed a sole risk operation, right, and the operating committee has said no, right? It cannot be on the basis that, oh, because Crest Petroleum doesn't have money to fund approved operations, NUBE will now propose sole risk. You understand? That's not the way sole risk works. Okay? So let's just be clear about that. In this kind of scenario, those who said farming arrangement is right. They're right. It could also mean that Crest, may wish to divest its entire interest. You understand? Or farm out a particular part of it to bring in, additional funding and share the rest, most importantly. Okay. And in terms of renewables and energy transition, right, what would likely happen is that Crest and both NUBE will probably look to divest their entire interest, just like we're seeing with some of the IOCs. So the intent of this exercise was just to practicalize some of the things we've discussed today, right? And then, infuse some of the contemporary issues that are happening in our oil and gas industry in Nigeria as of today. So I hope, that has helped in some small measure in understanding how some of these agreements are drafted and what issues to look out for. Thank you very much.
Thank you very much, sir. One moment. Yes, I wanted to stop the screen share so that, thank you so much for the presentation and the exercise, sir. It gave us a better understanding of all what we've been discussing since morning, and we really appreciate it a lot. You taking time out of your busy schedule. Again, I want to say thank you, sir. I know that you're very busy, and I want to say thank you for not pushing us to one of your partners or your associate to take this topic. Thank you so much. We appreciate you, sir. Again, we have come to the end of another exciting session of the Lawyers in Energy Network training in partnership with Centurion Law Group and Broomshy Consultancy. Like I've already thanked our speaker, sir, we are really grateful. And we know that whenever we call you, you are always ready to support us. So we thank you again. To our partners, we want to say a big thank you for making this event possible and for making it free to all the participants. We thank you so much. Don't forget that you can rewatch all the videos of the presentations on our YouTube channel You can watch this one and all the past videos on the YouTube channel. You can also watch us live. In case you don't want to subscribe to your Zoom, just go to your YouTube and type Lawyers in Energy Network at 11 a.m. Central African Time and watch us live. We only have one more day to go for this training, and we are going to also start tomorrow by 11 a.m. Central African Time. And I can assure you the person we're bringing tomorrow is also a very seasoned professional in the energy space, and she has a lot to offer us. Also remember that all the presentations can be gotten from your registered email address. So at the end of every day's presentation, we normally send a reminder email for the session of the second day of the following day. Kindly look carefully at that email. There are two links there. One is for the YouTube channel and the other is for the Google Drive. So on that link for the Google Drive, when you click on it, it takes you to access all the presentations for this particular training from day one till now. And our speaker, Mr. Lokulara, has been very magnanimous in offering us a draft of some of this agreement he spoke about to us today, which we are going to upload in the drive as we receive it. So please try to access it, and I'm sure that it's going to be beneficial to us. Finally, for those of you that have been asking us on how you want to join the network, you can join our network by going on our website on www.lawyersinenergynetwork.com. At the top page of that website is a subscription button. Just click on the subscription button and follow the process, make your payment, then the secretariat will get back to you. Don't forget, our training is tomorrow, like I've said, and please let's make it a time. Okay, thank you. I just saw someone talk to us about the certificates. We'll be at the end of today's training or tomorrow, we'll be sending out a link for you to fill. So that link, when you fill it, it automatically generates your certificates of attendance for you. Please fill those forms to generate and print out your certificate of participation. Also, attached to that link is a form, a feedback form, where we would appreciate if you can give us the feedback of this training so far, on our performance, where you want us to improve more for you and which area you would appreciate for us to train you in future. I remain Rakiba Oloko, and like I'm always saying, I'm the executive secretary of the network. I'm honored to be able to call to serve the network as the executive secretary. So I'm your host. I've been your host for this training for the past 7 days, and I'm still going to be here with you tomorrow. So see everybody tomorrow, and bye for now. Thank you.